Going back to behavioral finance, what would lead to regret minimization? What would feel worse? If your stock were to decline by 80, 90%, or if you were to sell or diversify or exchange and it were to go up another 3,000%, what would feel worse? In my role as head of investments, I'm often working with clients who have concentrated stock, and we've been dealing with exchange funds for years, and more recently came across cash and excited to have it as another strategy that we can implement. Concentrated stock, that's one of the most interesting and challenging things that we often come across. The saying is concentration builds wealth and diversification preserves wealth. We happen to work with a lot of clients who have a background in tech, who've accumulated stock options, equity comp over the years. It's done very well for them. And now it's also created a pretty large risk and tax liability. So being able to think through thoughtfully, how to divest, how to diversify, how to manage the associated tax bill that could come with it, and to really recommend and incorporate some innovative strategies, we think that's a real differentiator for us at Revolve. We have been working with exchange funds, legacy exchange funds for years, but we always found the process to be archaic and not so user-friendly. Paperwork, higher fees, higher minimums, challenges with subdocs and onboarding, and we're really thrilled that cash has helped to streamline a lot of those antiquated processes. But when we first heard about cash and what the team was building, we were excited because we thought it was sorely needed in the industry. Being fully independent, being an RIA, we have flexibility in our offerings, and we are in a position to do our own diligence and ultimately decide which managers we want to partner with. We had multiple conversations with StreetConf, with the entire team, really. We got to learn about their backgrounds. We got to learn about what they do differently from some of the legacy managers that we have more familiarity and exposure with, and how they're taking what works and effectively making it better. As a firm, everything we do, we lead with planning, and we figure out what are we trying to solve for. Do we want to fully divest from this position? Do we want to diversify down to a specific percent? Do we want to do it immediately? Do we want to do it over a period of time? Is there a tax budget? And what are the other considerations that we want to bear in mind? And then we'll go into our toolkit. We're quite familiar and experienced with 351s, with direct indexing, with strategic sales, with options overlays, a lot of different ways that we can tackle this. And oftentimes it will be a combination of several of those. For the clients who understand that they need a plan, whether it's something minor, whether it's something major, those are the ones who tend to gravitate towards these types of strategies the most. But it really does run the gamut. We have older clients, younger clients, clients with more liquidity needs, less. The common denominator is that all of them are looking to diversify, and all of them are looking to do it in a thoughtful, methodical, and tax-efficient way. So when I think about specific examples, use cases, one that jumps to mind, I think, is UnitedHealth, UNH. That company went through some significant turmoil, and the stock price declined rapidly. And fortunately, we were able to get ahead of that by introducing diversifying strategies like cash, which in turn saved our client hundreds of thousands of dollars during that decline. And one thing we always talk about is process over outcome. When we enter into a strategy like cash, we do it with the understanding it's not because the underlying position is necessarily going to crash. It's because we believe it's prudent within the context of that client's broader financial plan that they not have a third of their wealth tied up in the fate of a single company. There are plenty of advisors out there who may offer an exchange fund product, but not all of them can do it in a way that is less expensive, a more seamless digital onboard, more democratized. Those are, in general, the types of strategies that we tend to gravitate towards. So when it comes to communicating with clients, we always try to really go back to what are the goals? What are we trying to solve for? And if you've already won the game, why keep playing? Going back to behavioral finance, what would lead to regret minimization? What would feel worse, right? If your stock were to decline by 80, 90%, to suffer a catastrophic loss, or if you were to sell or diversify or exchange and it were to go up another, 3,000%, what would feel worse? The exchange fund concept itself, we think, has a lot of merit, and it's simply a matter of, can you package it and deliver it in a better way? And we think cash has done just that.